Apollo, great to see you again. And, today what I'd like to talk about is a lot of talk with inflation fears that are kicking in. We see the bond market sort of jumping around and rates going up, which means the value of the bond goes down. And then you throw on the government stimulus package. I think it's at $1.9 trillion. It's really mind-boggling, it is. But talk to us today about, has the discussion of inflation been with us before? And if it's not of this measurement, what do you think the markets, or how do you think the markets are going to react? Or should we change our strategy based on what we know?
Right. Well, let me start with a very short answer. The answer is absolutely not. There's no evidence right now to say let's change something. You have a financial plan. You're better off sticking with it because it's very diversified. It's not just in the U.S. It's across the world. It's stocks. It's bonds. But let's go back to the first point that he made, which we have a stimulus that has been put forth, and in fact, this idea of a stimulus goes back to last year. So what's the economic intuition? I know there are politics involved in this, and different people have different views from a politics perspective. Very valid. I'm not here to talk about that. I'm more looking at the economic situation and what it meant for the markets, what it meant for us as individuals. And let me start with just maybe, picture a family about a year ago when we first started doing these webinars, Greg. And you got a family with a couple of kids, and all of a sudden the parents out of work for no fault of their own because the economy shut down and there are lockdowns. And all of a sudden the kids are used to getting some pizza, and they're not getting the pizza anymore. And the kids are upset and they're crying. And it's not just about the kids being upset and crying, but it's also that the local pizza shop from where they bought, well, because they're not getting customers, they can't pay their employees. So their employees are not getting paid and they cannot go buy things. And furthermore, the pizza shop is not buying the flour from the farmer, is not buying the meats, it's not buying the veggies. So it has an impact, not just at the pizza shop level, but down the road. So the stimulus really from an economic perspective was designed to plug that hole and put a backstop to something that could have snowballed into a lot worse of a situation. And a lot of economists, some of them we had on our website, they really kind of suggested that the timing was good and it did actually accomplish the goal. So the stimulus itself, it helped families, and the kids weren't crying if they got the money for the pizza. The local businesses, the main street businesses got some help because consumers had the money to spend, but also the stock market because the larger companies also received some purchases from the households because of the stimulus. So as a whole, the stimulus helped everybody. It helped the households, it helped small businesses, and also the larger ones as part of the market. Now, what's the catch of that? And you kind of touched on that. The big concern that people have is inflation. Could this potentially lead to inflation? And to go back then to get a perspective on that, let's remember 2010. We had just emerged from that financial crisis, and at the time, the Federal Reserve was implementing a program called quantitative easing. And since then, we had quantitative easing 1 and 2 and 3 and so forth. And what these programs did, basically at a fundamental basic level, they just dumped a lot of money in the economy, as you might say in popular jargon. So it's a lot of money that was put in the economy through these programs. And at the time, it was a very similar concern. I would remember talking to investors, and I get the same question: isn't it possible that all the money coming from quantitative easing will lead to inflation? And yet it's been about 10 years, and since then, the inflation in the U.S. has been about 1.3, maybe 1.5, which is about half the long-term average. The long-term average inflation is about 3%, but also the Fed's target, which is about 2%. So how is it possible that after all the money that got put in the economy, somehow we did not see inflation, and in fact is even below the target? Why could that be the case? Because that might give us some guidance around how the markets are thinking about this stimulus package. And I think, again, to make it easy and intuitive, I'm just going to use just an intuitive example. Let's just say that I make pens. So I'm a pen manufacturer, and I have some orders coming in. I make the pens, I ship them out, everything's good. Now, because there's more, there are more dollar bills in the economy, I get more orders. Now, the thing is that if I have the capacity to produce more pens. I have the resources. I can hire a few people. Then I produce the additional pens. I ship them out. I don't have to raise prices as long as I have the capacity. The problem is that if I reach capacity where it's becoming harder for me to hire people or get resources, at that point I have to raise the prices such that some orders drop off and I can restore the balance. And if you take this at the macroeconomic level, what you see is inflation has two components. Has the demand side, which is from consumers, but it also there's a supply side, which has to do with the ability of the producer, the suppliers to create goods and services, and that is something that a lot of economists are paying attention to. So if we're going to see inflation or not see inflation, it's not just about the stimulus or quantitative easing; it's also about the ability of the economy to produce. And what we saw for the past 10 years is the capacity in the economy exceeded expectations because we're able to produce without raising prices, and that's a key insight. Because going forward, the big question is not just going to be the stimulus money, but does the economy have the capacity to produce? And this is something that every single day market participants are analyzing. Market participants are looking at this, and they're not stating their opinion like through an op-ed piece or through this video chat, but rather in the way that they invest billions and billions and billions of dollars. In other words, they vote with their dollars. So what do we see the markets telling us about the expectations that investors have? And one place to look at it is on the Federal Reserve of Bank of St. Louis. What they have there is they have a really interesting website. I'm going to share that with you because I think it's a really great place to start. On this Federal Reserve website, what you see is something called the 5-year break-even inflation rate. And what does it actually mean? It spells it out right below it. It is what market participants expect inflation to be in the next 5 years on average. And the way we're talking about they expect inflation to be is in the way that they invest in bonds. So there are different types of bonds. When you look at the different types of bonds, you can get that inference. And what you see is that going back to 2016 or so, the range of the expectations for this inflation rate were in the range of about 1 to 2%. Except when we had the March situation and last year, and at the time there was a real concern of the opposite issue, which is deflation, and at the time not having growth in prices. But when the stimulus got going, once we kind of understood better the pandemic, it kind of came back. And where we are today is that the market believes that as of Tuesday, March 2nd, that the inflation rate will be about 2.4% over the next 5 years. Which is still below the historical average. It's a little bit above what the Fed had stated, but again, it's not something that is overly concerning, and it's in fact in line with what a lot of economists consider to be a healthy rate. Now, we've seen a recent increase. And part of it is that it is quite possible that in the short run, until the economy gets over the coronavirus protocols and we kind of resume the full economic activity, in the short run, there might be more pressure on the supply side. And there was an article in the Wall Street Journal just yesterday, and what they were showing is that in the next 5 years, even though we have about a 2.4% inflation expectation implied by these bond rates, what you saw is on the subsequent 5 years, the expectation is actually below 2%. So in the short run, there is an expectation that the inflation will be sort of like in the normal range of about 2 to 3%. But as you go beyond that, it's not a big issue for the economy. So it was a long-winded answer, but it seems that in the way that markets are pricing the signals that we're getting from the markets, in the short run, the inflation might be a little bit above what we've had the last 10 years, but it's not by a lot. It's not something to really be concerned about. And subsequent to that, as the economy ramps up and the coronavirus protocols get set aside, then we're going to go back to the same type of inflation that we've had in the past. That's what investors are voting with in terms of their purchases of bonds.
Well, listen, that's just really a great overview on it. And going back to how we address inflation is nobody knows. Fortunately, we have a history of it. It's the same thing. You're giving great information out there, and their predictions again from the Fed. I think from our processes here, how we address inflation is we don't know, but we plan for it. And if it's not there, more power to us, right? So we think we have one of the more sophisticated financial planning tools. We have an inflation factor built into it, and it's adjustable. And honestly, it's a wonderful exercise to go through for those who are really caught up in the potential for inflation, where you just can address it by saying, well, let's just try it. Let's go ahead and put higher inflation rates in and see what it does. And traditionally, or our experience has been, the impact has been negligible, because we know that we have a market history of performance that will erase a lot of those inflation factors. And again, with a lot of information we get, we call it the reversion to the mean, right? You have a slope, you'll have down periods and up periods, but a financial plan really isn't designed for 1 year, 2 year, 3 years. It's a life plan. It's modifiable, but if you do it over a period of trying to guess where inflation is going to be today, tomorrow, in 3 years, it's kind of a wasted exercise. But if you do it over the long run and show the impact on it, I think it gives a better idea to the individual of how to address that concern. So again, great overview on inflation. Can't thank you enough, Apollo. And again, I know we'll be talking again in the future.
Hey, it was great talking to you. A pleasure, and thanks for having me.
Thanks for being with us today, and please follow us on all our social media platforms: Twitter, Facebook, Instagram, and YouTube. We look forward to seeing you on the other side.